All right, so the past week in the market has been very intense. We can see the major indexes right here, and just for reference, today is Saturday, December 4th. So on Friday, the S&P 500 was down 0.84%, the Nasdaq almost 2%, and the Dow Jones 0.17%. But perhaps the most concerning news is that tech and high growth names seem to be really selling off. So the Wisdom Tree Cloud Computing ETF is a great proxy for this, and just on Friday, it sold down 4.66%. And when it comes to the crypto market, the situation isn't much better. Just today, Bitcoin is down almost 9%, and over the past 7 days, it's down 10%. So what I'm going to do for you guys in this video is we're going to see what exactly is going on in the market and what's driving all of this insanity. And then I want to present a trend that I found in the market that is extremely telling and provides a lot of insight on how growth and tech names might perform going into 2022. So if you guys enjoy the content, as always, you know what to do. Leave the video a like, subscribe to the channel, helps me out a lot with the YouTube algorithm, and I greatly appreciate it. Okay, so earlier this week we had this article, so it's a little bit outdated now, but it does a good job summarizing exactly what's going on in the market. So on Tuesday, I believe, the Dow Jones dropped 650 points on growing Omicron fears and comments from the Fed about tapering their asset purchases. Now, more recently on Friday, stocks, especially those tech names, fell again. And the reason cited here on top of the previous concerns is that stocks dropped on Friday after a disappointing November jobs report. Technology stocks were amongst the most notable losers on Friday, as Tesla fell 6.4% and Zoom declined by nearly 4.1%. And when it comes to that November's jobs report, it showed slower than expected job creation. So payrolls increased by 210,000, well below the 573,000 that were projected. So the way I see this, there's three major categories of news driving these price movements. The smallest category are things like the November jobs report, as well as things like this. So China is actually cracking down on their tech names from listing over in the US markets. I think China has made it clear they no longer want technology companies listing over in US markets because it brings them under jurisdiction of US regulators. So our view has been that almost all of these US listed tech companies will relist in either Hong Kong or mainland China. So the underwhelming jobs report and the Chinese crackdown are small catalysts in the market. A mid-tier catalyst driving some of this is the fears over the Omicron variant. This is definitely injecting extra uncertainty in the market, and if there's one thing we know about the market, it hates uncertainty. But the reason why this is a mid-tier issue in my opinion is because so far the data that we have on this variant is that it has very mild symptoms, but in my take, the single largest piece of news and catalyst driving some of the market movements are from the Fed. So this article is titled, "What Fed Chair Jerome Powell's Hawkish Turn Means for the Market Volatility into Year End." So Fed Chair Jerome Powell says the central bank will discuss accelerating its wind down of bond purchases, known as tapering, at its December meeting. This is the money printer a lot of people reference when talking about Jerome Powell and the Fed. And the news here is that they're going to be bringing this to an end quicker than expected. So of course, the stock market doesn't like that. So Powell said transitory should no longer be used to describe inflation, meaning that it's becoming an actual problem and needs to be addressed. Okay, so those are the major catalysts driving the price movements in the market right now. But the question that I want to address right now is, why is this adversely affecting growth and tech names? So we saw a very tech-heavy cloud computing ETF over the past 5 days is down 11.29%. And I have to say, I think the major reason behind all of this is a valuation reset being caused by the Fed and the fight against inflation. So here's the price to earnings ratio of the S&P 500, and the PE ratio is a general way to measure valuations in the stock market. And this should come as absolutely no surprise, but right now the stock market has a very high valuation. And this expanding multiple of valuation is largely what drove a lot of the price appreciation in the overall economy. Over the past couple of years in the economy, people have kept bidding up the price of different stocks at a rate that has far outpaced the actual fundamentals of the company. And that's especially true for growth and tech names that have very high multiples that are way above that of the market. So here I have a collection of 7 different ETFs listed in order from lowest valuation to highest valuation. Under each ETF, I put its current PE ratio down. So SCHD, for example, right now has a PE ratio or valuation of 17.9. And I want to compare that versus its price movements on Friday. So SCHD on Friday actually went up 0.18%. Now let's move down this line and look at ETFs that have higher and higher valuations and see how the price action was this past Friday. So Divo is another value-focused ETF. The PE ratio is pretty low, 2.21%, and on Friday it was essentially flat, up 0.05%. Moving on, now we have the market, so this is a great benchmark, and the P ratio of the market is 28.6, and on Friday it went down 0.87%. Moving down the line, we have the QQQ next, which is a tech-heavy index. The P ratio here is 35.7, and on Friday it went down 1.74%. VGT is an information technology ETF, and here I want to point out that the P ratio is 40.7, which is pretty similar to the QQQ, just a bit more, and the price action on Friday was also similar to the QQQ, but just a bit more to the downside, 1.86%. Now the next ETF on this list is IGV, which has a pretty big jump in valuation. So the P ratio here is 92.2, and on Friday it went down 3.37%, a huge increase over VGT. And finally, the ARK Innovation ETF actually has a negative PE ratio of 85.1, meaning that overall the companies in this ETF are not even profitable, and this went down the most on Friday, 5.54%. So this trend of the higher the valuation, the steeper the price decline, is a clear indication of a valuation reset. And this valuation change is mostly being driven by the change in Fed policy. So this article is titled, How Interest Rates Affect Growth versus Value Stocks. So rising rates could lead to a headwind for any stock that's priced to perfection. A company's stock price is simply the value of future cash flows discounted by some interest rate. For added simplicity and to hammer home the next point, let's take one future cash flow of $100 arriving in 10 years and discount it back to today. We will do this twice, first using 0.5% as our denominator, then 5%. And this of course is representing a rate change by the Fed. So using 0.5%, today's value of that future cash flow is roughly $95.13. Using the 5% rate, today's value would be roughly $61.39. The rate used to discount these cash flows is incredibly important. The lower the discount rate, the higher the value attributed today to future cash flows of tomorrow, and vice versa. Considering the arithmetic again, think about the market we've been in. It has been dominated by growth stocks. These are stocks that trade at premium valuations. Some are fast-growing businesses that are expected to produce more and more income. Some have cool concepts with no income at all. Either way, the market is valuing future cash flows for these names at historically low rates, which has translated to high valuations. Now think about value stocks in the market over the past few years. They've been demolished by growth stocks, and the valuation differences are notable. We believe rising rates may continue to affect growth more negatively than value. At current valuations, market participants expect growth stocks to maintain extremely high growth to support these valuations, especially given the mathematical importance of discounting future cash flows at a higher rate. So because these tech names are priced to perfection right now, the valuation is super high, just in order to maintain that in an environment where the rate is rising, they have to have perfect earnings reports. And even then, it might not be enough to maintain their current valuations. Valuations do not increase simply because they have in the past. There's no way of getting around what a stock is, a claim on future cash flows. A value today is derived with simple math, with the discount rate a key input. Increase the discount rate while holding growth expectations consistent, and valuations must come down. Now, the good news is that prices don't have to drop for growth stock valuations to come down. They can simply stall out while the fundamentals catch up. So there you have it, guys, a valuation reset caused by a rate change in the overall economy. That's the main driver behind the sell-off in the economy in the past week, that's especially hitting tech and high growth names with extremely high valuations. And other factors like the Omicron variant and the poor November jobs report are definitely contributing, but they're smaller secondary factors in my view. So because of this, going into 2022, we might see growth stocks stall out for a while until the fundamentals can reach their high valuations. Of course, nobody knows what's going to happen in the future, and that's why I invest in both growth and low valuation income-focused investments. You guys know I love to use covered calls to generate income in my portfolio, and the income I generate by selling call options are directly tied to the volatility level in the stock market, represented by the VIX, which over the past 5 days is up 25%. So because of how I'm positioned in my portfolio, I'm gonna do fine no matter what, and that's the exact position I like to be in. But let me know what you guys think of all this in the comments down below. If you're still watching and enjoyed, definitely give the video a like, subscribe to the channel, helps me out a lot and it's greatly appreciated. But regardless, I'll see you guys in the next one.